All right, thanks everyone. Let's get started. Good morning. I'm Sarah Steen and I'm the founder of Miss Efficiency, and I'd like to welcome you to today's webinar. Just so that I can make sure that everybody can hear me and see my screen, please type hello into the chat box now if you can. Awesome. That's great. Thank you and welcome. Now, just a little background before we get started. I've been running Miss Efficiency for over 20 years, and our core purpose is to eradicate financial stress. And today we're talking all things end of financial year. And there's a lot to cover, and we'll give you a checklist at the end so that you can work through it in your own time. I'd also like to introduce you to Naomi, who's here with me today, and she'll be helping out with your questions. So if you have any questions or observations that you'd like to share, please pop them into the chat box as we go, and we'll do our best to answer them at the end. Before we get started, I just wanted to point out that the end of financial year is different for everybody, depending on the type of business that you have or where you're up to in your business journey. So if some of these things aren't relevant to you right now, I do encourage you to stick around and follow along anyway, because they may be relevant to you in the future. And I wanted to also say right from the beginning that this webinar is not about giving you tax advice. What it is about is giving you information on the things that you can do to prepare for the end of the financial year before and beyond June 30. And hopefully you'll get some clarity around things that you can talk about with your accountant, which is where you'll get some good tax strategies from. All right, so we're going to get started, and I'm going to share my screen with you now. Business owners who fail to prepare for the end of the financial year can face significant obstacles. And this lack of preparation can lead to cash flow issues and regulatory non-compliance. And no one wants an empty bank account or the ATO knocking on their door. The increased stress and workload from leaving things to the last minute underscores the importance of thorough financial preparation. And I see that there are 3 obstacles for business owners adequately preparing for year end. The first obstacle is finance is complicated. It can feel like a maze of jargon and numbers, but understanding your figures and preparing now sets you up not only for this busy close-off period, but also for the next 12 months. The second problem is busyness leads to oversight. And I get it. Life gets hectic, and running a business is not always a walk in the park. When we're caught up in the day-to-day whirlwind of running our business, it can be easy to overlook the finer details and the importance of setting time aside for preparation, reviewing, and planning. But these things are the key to staying compliant, improving cash flow and profitability, seizing opportunities, and avoiding pitfalls. And the third problem is finance is often deemed boring. Let's be real. Finance can have a reputation of being a bit of a snooze fest, but I can assure you that preparing now is going to save you later. So while there might be some more enjoyable things to do, preparation now could be the game changer you never knew that you needed. Can anyone relate to any or even all of these challenges? If you can, let us know in the chat. So today we're going to touch on quite a few things that you can do to prepare your business for the end of year. We're not diving deep into each aspect because there's not enough time for that. The purpose of this webinar is to give you guidance on the things that you could be thinking about and preparing for. And like I said before, we'll give you a checklist at the end that you can work through. And if you feel that you get that and feel that it's still a little overwhelming and would like some help, Naomi will pop my calendar link in the chat so that you can book in a time to talk with me and see how we might be able to help you. And I'd love to know what you're hoping to get out of today's webinar. Please pop it in the chat now. Okay, so we've got a few things there and a couple of private messages coming through as well. And I'm pretty sure that we've got you covered today. So right now, we're going to dive into preparing for the end of financial year. If you haven't already had a meeting with your accountant this year, now is the time to do so. Actually, now could be even a little too late, as there's not much time left before June 30. And some things that could be put in place to maximise your financial position for this year really do need to be done before then. But don't worry, because there is still plenty of things that you can do. So an investment of an hour with your accountant is definitely time and money well spent. And then I'd encourage you to look at your calendar for next year and block out at least 2 times when you're going to have a strategy and planning meeting with your accountant, say in October and March. These are great points during the year where you and your accountant can discuss where you've been, where you're going, and there's still plenty of time to course correct if necessary. Seeing your accountant in July or August, it's sometimes too late to make adjustments from last year because the year's already over. It's best to see them during the year to check in on where you're heading and put you back on track if necessary. And please, for the love of your bookkeeper, please don't let us know on the 3rd of July that you have a meeting with your accountant in 2 days' time and will my accounts be ready? Because they probably won't be. Now, before you meet with your accountant, let's look at a few things that you should do to prepare. Firstly, bring your accounts up to date. Now, it might seem obvious, right? But we can get caught up in the business of doing business. And that other than the top level, such as paying your team, invoicing your clients, paying your bills, all of the other stuff behind that can get forgotten. And failing to keep your accounts up to date or to be across all financial aspects of your business can be a downfall for many business owners. You may have an internal team or an external bookkeeper looking after your accounts, but it's important for you as the business owner to be familiar with all aspects of your business's financial position. And I've seen it many times where we've taken over the accounts for a client only to tell them that their superannuation is behind, or their BAS isn't lodged, or that despite the big green tick, the bank account actually doesn't reconcile, or their income, expenses, GST, overstated because of duplication or incorrect reconciliations. So get things up to date and then keep the lines of communication open with your bookkeeper to ensure that everything is where it's supposed to be. And if your accounts aren't up to date, put systems in place so that they can be updated on a regular basis, such as data entered, accounts reconciled, reports reviewed. Now again, this might seem obvious, but there are many business owners who are just so in the operational side of their business, they do the bare minimum when it comes to their bookkeeping and think that they'll get to it in their spare time. But really, who has spare time? And if you do have spare time, who wants to be spending it on bookkeeping when you could be growing your business by developing new revenue streams, investing in your team and your client experience, or spending it outside your business with family and friends doing what you love? So the benefit of keeping your accounts up to date is more clarity, more opportunity for growth, more time for the things and people that are important. And that's not just an end of year thing, it's an all year round thing. Does anybody have any questions or observations that they'd like to share about bringing your accounts up to date? If you do, just pop them in the chat now and we can discuss them at the end. Okay, so now let's talk about reconciling your bank account. Reconciling the bank account is one of the fundamental steps of accurate and up-to-date financial data. And Xero makes it so easy, right? But here's the thing. Xero are excellent at marketing the ease of their product. And what you don't realize is that sometimes on the face of it, things seem okay, but beneath the surface, there are some issues. So when we're talking about reconciling your bank accounts in Xero, we don't just mean match the bank feed to the transactions, because as nice as it feels to get that big green tick, it's only the first step. So once you've got that, you need to run the bank reconciliation report. That's the actual reconciliation process, which is verifying that what Xero says in the bank is actually in the bank. So let me show you how to do that in the Xero demo file. Okay, so firstly, let's look at the bank account or reconcile, right? So now let's look at the reconciliation report. To find that, we're going to go through the three dots and click on reconciliation report. And you can also find this through the reports menu. Now we're going to filter the dates to the last month and ensure that we're looking at the correct bank account and update. This shows you things that have come through the bank feed that may not have been reconciled, but we're all good there. It also shows you things that have been entered as paid or received that haven't been reconciled against bank entries. Now, some of these could relate to items that are in the bank feed that aren't yet reconciled, but some of them could be duplicates. And this often happens when a received money transaction is reconciled against a bank feed instead of reconciling it against the sales invoice. And then the sales invoice is receipted, but stays unreconciled because the bank line has already been reconciled incorrectly. This means an incorrect bank account balance and duplicated revenue. And that's the case here. The next thing to look at on the bank reconciliation report is the actual bank account balance and match that to the bank statement and make sure that there's no out of balance amount. Now this should be zero, this figure here. If it's not, there's an issue with your bank feed data. Now, sometimes the bank feed can be incorrect, and there are a few reasons why this could happen. There's a disruption to the feed, there's a gap between manual data and the bank feed starting, or there's been some manual manipulation. If there's an out of balance on your bank reconciliation or the bank balance in the bank rec doesn't match the statement, it's definitely something that you should leave to your bookkeeper to fix. Sometimes there's a bit of unraveling and investigating that needs to happen to know how it went out of balance. And then it can often be a little bit of a tricky process to fix it. So not something we'd recommend if you haven't had experience in this area before. Let me tell you a story about a client where there were two credit cards on one account and only one card had transactions feeding through to Xero. So all of the transactions on the other card were not being captured. So on the face of it, this account seemed to reconcile, but by only reconciling what came through the bank feed and not checking the reconciliation report, they missed tens of thousands of dollars of expenses. This meant incorrect BAS and incorrect tax returns, and the business owner was relying on inaccurate data to make decisions about the direction of her business. When we came on board, we immediately identified that there was an issue just by running the bank reconciliation report. But it wasn't until we did a little bit of digging that we found what the issue actually was and how we could fix it. Does anybody have any questions or observations about the bank reconciliation process? If you do, just pop them in chat now and we can discuss them at the end. Okay, so now let's move on to your accounts payable and your accounts receivable and I'm going to reshare my slides with you. It's important to look at what is owing to you and what you owe. And as we've seen from the bank reconciliation process, sometimes there could be revenue and expenses reconciled incorrectly, leaving invoices and bills outstanding. This leads to inflated revenue and expenses and an incorrect position of what's owing and what's owed. This means for your sales invoices, you may be chasing your clients for invoices that they've already paid, which is embarrassing and could cause a loss of confidence. And on the payables side, you could look at your payables and think, oh, whoops, haven't paid that bill, and end up paying something twice. So let's start by looking at your accounts receivable, and I'll switch over to the Xero demo file to show you. Now, to get to accounts receivable, we want to go up to business, invoices. And let's look at awaiting payments. This is everything outstanding to you according to Xero. So from here, you can filter your search based on a number of parameters, giving you a slightly different view of the same information. So you could search by your customer, or you could search by the due date. Or you could search a certain customer just to show their information. Now let's go back to seeing everything. Not being paid is one of the biggest disruptors to cash flow. So the first thing I do is go through what's outstanding and sort by the invoice date. How old is the oldest invoice? And we're not just looking here for things that may be incorrect, but we want to be chasing up those old invoices too. You've worked hard to provide a service, so you should be paid for it. This is where you can start on collecting what's owing to you. And then coming back to your oldest invoices, are there any here that are bad debts that should be written off? There's no point paying tax on income that you're not going to see. Or maybe you could arrange a payment plan with the client so that you can at least get some cash in the bank. Next, you want to check through all of the sales invoices and see if there are any credits, prepayments, or overpayments that should be dealt with. And to do that, we're going to click on the due field, and this will bring all of our credits to the top of the screen. Do refunds need to be applied? Or do you have outstanding invoices that should have prepayments or credits applied? And maybe this would be a good opportunity to look at the way you're invoicing and collecting your money. How quickly are you invoicing? Could you invoice more frequently? Could your invoicing system be optimized? And how are you collecting your money? Are you making it easy for people to pay by giving them plenty of payment options? Maybe you could implement a payment gateway such as Stripe or Go Cardless. There's lots of opportunities here. Now let's look at your accounts payable. And to do that, we want to go to Business, Bills to Pay. And we're going to look at your bills awaiting payment. Again, you could sort by the bill date or by the supplier, whatever is going to give you the information that you want to see on the screen. Review what you owe to your suppliers. Are there bills there that have been paid with cash or with personal funds, but are still shown as outstanding? Are there credits outstanding that haven't been applied or refunds received? Are there large bills outstanding where you could speak with your supplier and maybe put a payment plan in place? And with the end of financial year in mind, make sure that you're capturing all of your bills. If you've got somebody working on a project for you, can they get it done and billed to you before June 30? Again, there's lots of things to consider here. Now I'm just going to switch back to my presentation. Next, it's a good idea to review your expenses. There may be things that you're paying for that you no longer need, or you might be paying for a higher level of service than you need, or you might just be eligible for a better deal. There's the obvious things like insurance and telephone. If you can stand to be on hold or have the time to pop into a store, chances are you can sign up for a better phone plan. And with your insurance, do you actually have adequate and relevant cover in place to protect against all risks which may affect your business? Could you be saving money by shopping around or asking for a better deal? Now, you could go line by line through your profit and loss, analysing what you're paying. And that seems like a bit of a daunting task. So it's pushed to the back burner, never to be thought of again. So if there's one thing that I'd suggest you don't push to the back burner, is to do a review of your software subscriptions. Gone are the days of desktop software, and everything we do these days seems to require a subscription. And they make it so easy to sign up for something as a free trial, you forget about it and don't realise that you're paying for something that you don't need and don't even use. Or you could have signed up for a higher level, and when your needs changed, you didn't reduce the subscription. We recommend separating your software subscriptions in your accounts so that you can easily identify what you're paying for and regularly do an audit. It's so easy to let subscriptions fly under the radar, but they quickly add up. So review your active subscriptions and cancel any that aren't relevant anymore. It's a great way to get some more money back in your pocket, and it could be fun to choose some new ones for the new year that better meet your needs, or earmark that money for something else. Does anybody have a story they'd like to share about reviewing your expenses or how you keep track of your subscriptions? If you do, just pop it in the chat now and we can discuss it at the end. So now we're going to look at how you can maximise your spending before the end of the financial year. Okay, so this might be where you get to go on a little spending spree before June 30. But I'll preface by saying this: don't spend $1 to save 30 cents in tax. And don't jeopardise your cash flow in order to get a tax deduction that you may have gotten next year anyway. But if cash permits and it makes sense to do some spending prior to June 30 to maximise your position, then here's some ideas. You could get your car serviced. You could replace your tyres. You could pay your annual membership fees. You could pay your subscriptions annually rather than monthly to get a discount. You could pay your annual insurance. Again, you might be able to get a discount for paying upfront rather than monthly. You might be able to pay a few months' rent in advance. And do you need to upgrade or replace any equipment? Now, this could be, there could be some tricky things around the timing of this. So check with your accountant if you're planning to make some big purchasing decisions. And what about paying yourself some additional wages and super? Again, be aware of the super caps and the tax thresholds, and maybe have a chat with your accountant first to check on your current tax position, because you don't want to be paying yourself too much and have it actually cost you more. Would anybody like to share what they prepay in order to pull the expense forward in the current year? Yeah, Leon, we definitely have some suggestions around superannuation, so we'll talk about those at the end. And definitely a great idea to update your equipment and your computers. Take advantage of those end of financial year sales. And now we're going to look at the cash. And when I say cash, I actually mean actual notes and coins. So firstly, count the money. And for some of you, this won't apply, but there are still plenty of businesses that collect cash, so it's important to track and account for this correctly. whether it's in a petty cash tin, and if that's the case for you, let's talk privately about a more efficient way to manage that, or it could be cash floats and tills. It's important to know how much cash you have, where it is, what you plan to do with it, and that it's recorded on the balance sheet, just like any other amount of money that's in your bank account. If there is a lot of cash going through your business, I'd actually recommend a reconciliation much more regularly than annually. Where cash is concerned, it's very easy to go out of balance or simply disappear, so you must be vigilant. So depending on your business, your reconciliation process could be monthly, weekly, or even daily, so that any discrepancies can be picked up quickly. Make sure you have good systems in place for managing your cash, and then also passing this information on to your bookkeeper so that they can ensure it's reconciled accurately. And let me tell you about a client who's in hospitality and has a lot of cash going through their business. Before they were accounting for their cash well, there was cash everywhere, like literally. They had multiple green buckets of cash everywhere. So we put some systems in place to contain the cash, know where it is, and track it on a daily basis. Now we record the closing cash on the balance sheet and can quickly identify issues such as too much cash being held, cash being misplaced, or used for expenses that haven't been taken up. Remember, without visibility, you don't have clarity. And these guys that I'm talking about, they had visibility of all of their green buckets, but they had no idea how much cash they actually had on hand or where it was going. Does anybody have any effective or unique ways that you track your cash that you'd like to share? If you can, just pop it in the chat box and we'll discuss it at the end. Now we're going to talk about stock tax. Depending on your business, you may or may not need to do stock takes. And if you do, they could be done weekly, monthly, quarterly, or annually. And there's really no right or wrong here, as long as you're consistent in both the frequency and the way that you do the stock take. Now, for some businesses, a stock take could mean going around with a clipboard and actually counting stuff. And that could be time consuming, and there's the potential for human error. Other businesses may have systems connected to Xero where you record the stock as it comes in and goes out. So effectively, you're keeping your stock take up to date with every sale and purchase. And this is awesome. No more wandering around the warehouse counting things on shelves. But technology is only good as the data, and the data is only as good as the process of inputting that data. So while I encourage you to embrace technology, I caution you against blindly trusting its accuracy and have your own checks and balances in place to prove the numbers. And a bonus end of financial year tip for you: when you're looking at your stock takes, remember that all that stock on the shelf relates to money not in your bank. It's actually money out of your bank because you've probably already paid for it, but haven't yet converted it to cash. So how long does it take to ship some of these items? What can you do to turn them around quicker, therefore getting cash into your bank account quicker? And if you've got stock on hand that just isn't selling, maybe you could have an end of financial year sale just to get it moved and cash in the bank. Are there things that you've got in stock that you sell so infrequently, you could just order them as a one-off purchase rather than have money tied up until the next sale? Or on the flip side, are you turning things over so quickly you could actually afford to have a little more in stock and get volume and freight discounts on larger orders? So coming back to the stock take, what do you do with the numbers? Well, you give them to your bookkeeper, of course. And we don't actually need to know how many widgets you have, but we do need to know the value of your widgets. This is an asset to your business, and we'll record this and show it in your financials. Would anybody like to share how you account for your stock? If you do, pop it in the chat now. Okay, so now we're going to talk about work in progress. You might be a business that has work in progress. You could be a business who bills for your time or for projects. Think about the work that you've already done on the project that you haven't invoiced. That's your work in progress. You've done the work or some of it. You might have paid some expenses or some wages that relate to it, and you've received no cash in exchange. So there's two things that you can do with your work in progress at the end of the financial year, or like the stock take, more regularly would be my recommendation. Firstly, look at what you can invoice now and potentially receive payment for before June 30. Personally, if I'm paying somebody $30,000 for a project that's going to take 3 months, I'd rather pay them $10,000 each month than $30,000 all up front or all at the end. It's still the same amount, right? But it's easier on my cash flow to pay smaller, more regular amounts. Maybe your clients feel the same way. And look at your work in progress and decide if there are some milestones that have been reached that you could invoice now. What's left uninvoiced is your work in progress. Put a dollar value on that and give it to your bookkeeper to enter into the accounts. Tracking your work in progress is similar to tracking your stock. There are many ways that you can do it, and there's no right or wrong. For some clients, we have some clients tracking through software, and others are using a humble spreadsheet. Would anybody like to share how you track your work in progress? Just pop it in the chat and we can talk about it at the end. So now we're going to move on to your asset list. So look at the assets that you've purchased during the year. Think computers, machinery, motor vehicles. Consider how these have been recorded in your accounts and make sure that your accountant knows where they are. So don't lose your computer in the profit and loss under the office expenses account when it should really be on the balance sheet under computer equipment. Some assets will be allocated to the balance sheet, and these are typically the larger value assets that are depreciated over time, such as your motor vehicles. And other smaller assets will be allocated to the profit and loss, and this could be something like an iPad. That's still an asset to your business, but the value is low enough that it can go straight to the profit and loss and get fully expensed this year. Now, I don't want to get too complicated about what should go where, but there are two things that are important here: consistency and source documents. Firstly, consistency. Be consistent in the way that you code certain things and think about the logic of your coding. Develop some rules about where and how you code items so that you get the level of detail that you need without getting overwhelmed by it. Secondly, source documents. Gone are the days of receiving a paper invoice, manually entering it, and shoving that piece of paper into a filing cabinet, never to be seen again. Well, hopefully those days are gone anyway. Now we receive a lot of our information electronically. We can enter it via an app such as HubDoc, and the source document, which is the bill from your supplier, is attached to the transaction in Xero. Now, your accountant will love you for this. And you will love that you're not having to find a whole bunch of paper receipts that you may actually have filed in the bin. Would anybody like to share how you keep track of your assets? If you do, just pop them in the chat. Okay, so now we're going to talk about taxable payments annual reports. The taxable payment annual report is also known as TPAR. Now, this doesn't relate to all industries, but if you're in building and construction, cleaning, road freight, couriers, information technology, or security, investigation, or surveillance, then this is for you. So personally, I think this will eventually be required for all industries, but we're not there yet. TPAR is a document that needs to be submitted to the tax office in August and gives them information about payments that you've made to your subcontractors. It was brought in quite a few years ago in an effort to stamp out non-compliant payments to subcontractors, and ensure that subcontractors were declaring their income correctly. And a hot tip for you, even if you don't engage subcontractors, if you're in one of these industries, you still need to lodge a report. So in this instance, it would be a nil report. If you do engage subcontractors, TPAR means it's more important than ever to ensure that you have source documents and up-to-date information in your accounting software. And we have a little tip that I can show you about how you can, something that will help you extract this information more easily. And that is to set up a contact group. And I'm going to show you how in the demo file. Okay, so in Xero, we're going to go to contacts and all contacts. From here, we're going to select the drop-down next to groups and select new group. Give the group a name. In this case, we're going to call it TPAR and create. Now we want to select the supplier to add to the group. So say it's this one. We're going to click on the three dots, manage groups. I'm going to add them to the TPAR group. Now, when you run your reports for TPAR, you simply need to select the TPAR group rather than individually selecting subcontractors to add to the report. And actually, there could be many other reasons for you to use contact groups. It's really just a way to filter information in your reporting. So you might want to know the location of your customers. So you could create contact groups based on location. Or you might have clients in different revenue brackets. So you could create groups based on that. The options are really limitless. Does anybody have any questions or observations about TPAR or contact groups that you'd like to share in the chat? Okay, so now we're going to move on to superannuation, and I'm going to re-share my slides with you. I cannot stress enough how important it is to keep on top of your superannuation payments. And Xero makes it super easy to stay compliant. I've seen it many times where cash is tight, so superannuation payments get behind. Now, business owners don't think it's a priority because the super funds usually aren't banging on your door asking for payment like suppliers might be. And I totally get it. It's really important to keep on top of your supplier and your team payments because without them, you won't be able to deliver to your clients. But not paying your superannuation can have far-reaching impacts for your team, for your business, and for you personally. With single touch payroll, the tax office is more aware than ever before how much super you owe and when you pay it. And there is no leniency on super. If you are just one day late, penalties will apply. So first, bring the superannuation up to date. If you've got overdue super, ask your bookkeeper to help you with what's called an SGC charge statement. This is basically a form for the tax office advising them of the late or overdue super, which they already know about. They're just not knocking on your door yet. And when they do knock on your door, it's in the form of an audit, which is not what you want. There will be penalties and interest applied, but early disclosure is important as the problem is not going to magically fix itself or go away. So it's best to get in front of it. If you've paid the super, but it's late, also do an SGC charge statement. Penalties will still be incurred, but if you wait for the tax office to eventually catch up with you, they'll be a lot higher. If you haven't paid the super and cash is still tight, lodge the SGC charge statement forms to the tax office and the super can be paid to them rather than to the super fund. And unfortunately, it will take longer to get to the employees' accounts, but at least this way you can put a payment plan in place and you're squared away. And one hot tip for you, if you are the director of the business and on payroll and have paid super for your team, but not your own, the same rules apply to you. So don't think that penalties won't apply for not paying your own super. Now, how do you keep on top of your super and stay off the radar of the tax office? Quite simply, you pay it on time. Now, we all know the due date of super is the 28th of the month after the end of the quarter, but don't be mistaken into thinking that that's the day you should make payments and you're all good. The 28th is actually the day funds need to be in your employee's super account. So it's got to go out of your account into the clearinghouse, and then they distribute the money to the employee's super fund. Now, you'd think with the technology currently available, this would take a day, 2 at the most, right? Afraid not. If you're lodging super through your Xero software, which I recommend that you do, you should allow 14 days for this process to happen to ensure that the money is in the employee's super fund by the due date. And if you're using software other than Xero, check their recommendations on the cutoff date to ensure it's lodged and paid on time. Now, up until recently, we were lodging most of our clients' superannuation monthly rather than quarterly. And we've recently introduced payday super across the board. This means that as part of our payroll process, superannuation is paid at the same time. This means there will never again be late super and the penalties associated with it. Any returned super issues can be sorted without worrying about a deadline looming, and it's great for easing the cash flow burden at the end of the month or quarter. And it's going to be law soon anyway, so we're just getting a little ahead of the game. Does anybody have any questions or observations about super? If you do, pop them in the chat and we can talk about them at the end. Leon, we can send you some links to the ATO site where you can get that information. Now let's talk about the rest of the payroll process. Reconciling your payroll. Now, this is a biggie, and I could spend the whole session just on this. So I'm just going to cover the highlights, and these things plus some others will be in the checklist that you get at the end. So firstly, make sure your information is up to date. Have they moved and not updated their address with you? Did you have incomplete or incorrect information to begin with that needs to be updated? If they've authorised a salary sacrifice, do they want to continue or amend it? Next, make sure your superannuation settings are set to the statutory rate as default. That means that when the rate changes, which it's set to do for the next couple of years, the software will automatically update it for you. And let me show you what I mean in the Xero demo file. Okay. So from here, we're going to go to payroll and employees. And let's look at James. And we're going to jump over to his pay template. Now, if you scroll down, you'll see that in this instance, the superannuation is set up as a percentage, and it's not even correct. Instead, click on the super fund, which will open up the settings. And now we want to change the calculation type to statutory rate. Click OK, and then save. Now superannuation will be calculated at the current rate, and when the rate changes, it will automatically update. So if you have it set as a percentage, you will manually need to adjust this for every team member. Next, you want to check your payroll settings to make sure that they're correct before the single touch payroll finalization process. To check the settings, we go to payroll settings, and let's look at the pay items. Now, I'm not going to run through each one of these, and yours will look a little different to this. But some of the things to consider are the allowances. Are they set up correctly? Are the earning items set up correctly? Is leave accruing correctly? Are all of your items set up correctly for PAYG and super? And if you have an all-purpose allowance that's part of the base rate, are you recording that correctly? Now, you might be wondering what an all-purpose allowance is, and it mainly relates to the building and construction industries and came in with the second phase of single touch payroll. Every new client that we've taken on since this was legislated has been reporting this incorrectly. So if that could be you, I encourage you to talk to your bookkeeper or reach out to us about it. Now, I'm just going to flick back to my slides. Now, what about your workers' compensation? Each state has slightly different rules, so it's important to ensure that you're across the rules for your state. And if you have workers in multiple states, which in the rise of remote working is more and more likely, you need to have a policy in each state. Actually, workers' compensation is something that you should keep an eye on during the year, because if your actual wages increase significantly from the estimate, your insurer may reject you if you make a claim. And if you don't make a claim, you could be penalised with a higher premium next year because of your underestimation. I came across a story recently where this actually happened. The workers' compensation claim was rejected because the wages estimate hadn't been updated after significant payroll growth. This meant that the employer was responsible for the medical costs of the claim, which resulted in financial hardship, and ultimately the business closed down because of it. Now, moving into the new year, it's important to be across any award changes that may be coming in from July. And here's a free bookkeeper's tip for you. Award increases happening in July are from the first full pay period. So if your first pay in July spans any part of June, the new rates come in from the next pay. So often it's not until the second pay run that the new rates actually come into effect. And because Fair Work likes to keep things complicated, some awards don't actually update in July, they update in October. So if there are no changes to your award in July, don't assume that there won't be any at some other point in the year. If you do, you could potentially be underpaying your team. But there was an announcement recently that the national minimum wage will be increasing by 3.75% this July, which likely means that all awards will be updated. And Fair Work also like to keep us hanging a little, so may not publish the new rates until the 1st of July. So that can be a pretty hectic time to ensure the correct timing of updates. So next we're going to look at, next it's a good idea to check your team annual leave balances. And I'm going to show you how in the Xero demo file. Okay, so to see your team members' accrued leave, we want to go to accounting and reports. and scroll down to the payroll section and select leave balances. And you could put a star next to this to make it a favorite. So open up the report. Let's look at the end of last month and we'll group it by leave type and update. Now you can see here that James's annual leave is getting up there. If you've got team members where their leave is creeping up, have a chat with them and encourage them to take some leave or cash some in. Now, there are some rules around cashing out leave, so make sure that you're across those before doing it. Now, I'm just going to jump back to my slides. Now, there are a few reasons why keeping on top of excessive leave is important. Firstly, you don't want your team burning out because you can't remember the last time they took a holiday. Next, annual leave is paid at the current earnings rate. So if you give annual pay rises, you're paying leave for leave that was accrued in 2018 at 2024 rates, which means it's costing you a lot more. Finally, what if they resign? That's potentially a big cash hit that needs to be paid in one go, and there's no payment plans for termination pays. There's so much to be across with payroll, it's ridiculous. And I've added some other things into your checklist, but I think that's quite enough about payroll for now. It's complicated, there are many variables, and there's a lot to know. So if you need some help with it, chat with your bookkeeper or book a discovery meeting in with us. If you have any questions or observations now about finalising payroll for the year, you can put them into the chat. All right, so we're nearly there. The end of the financial year can be stressful for many business owners, but it doesn't have to be. It's not all about reports and figures, although they're important, and I totally get it. There's a lot to do. And as busy as this time of year is for me, I actually love it. I thrive on the challenge and see it as an opportunity to complete the circle on the year, to see where things went well, where there's room for improvement, and get energized about the coming 12 months. And aside from all of the compliance stuff, this is a great time to review your business position, your systems, and your plans, ready for the year ahead. And doing a review and planning for the year can give you amazing clarity and insight into where you've been, which is great. But more importantly, it can be like a crystal ball telling you where you're heading. So as we come to the end of this webinar, we've learned that there's more to the end of the financial year than just flipping the calendar over. And there's a lot to consider, but the key is preparation. So moving forward, you have two pathways. Pathway A, you can do it yourself. Work through our checklist, maintain open lines of communication with your bookkeeper and your accountant, monitor the deadlines, and ensure that you're staying up to date and compliant. Pathway B, you could let us help you. So you can book a time for a chat and we can see how we can work together to ensure your end of financial year is as stress-free as possible, setting you up for success in the new year. So if maximising your financial position is important to you, you can book a discovery call in for us. And we understand that as a business owner, you're juggling multiple responsibilities and wearing many hats. You're deeply invested in the success of your business, but the demands of the day-to-day bookkeeping can be overwhelming. It pulls you away from your core strengths and the strategic activities that drive growth. You might feel stressed about staying compliant with regulations, ensuring the accuracy in your financial records, and managing the cash flow effectively. And the end of financial year only amplifies these pressures with additional tasks like finalising payroll, being on top of additional reporting, and planning for the year ahead. And we know that your time is valuable and your expertise is best utilised in areas that directly contribute to your business's growth and profitability. The operational burden of financial management shouldn't stand in the way of your success. And this is where we step in. So when you book a discovery call with us, you'll get personalised insights into how we can develop a strategy to improve your clarity in your business. We'll work together to craft a strategic roadmap that will not only help you navigate through the end of the financial year, but also set you up for long-term success. And you'll come away with clear, actionable steps to enhance your financial game and drive your business forward. Imagine having the burden of bookkeeping lifted from your shoulders, freeing you to focus on what you're truly passionate about. Our goal is to eradicate financial stress by empowering you with the tools and strategies needed to streamline your financial operations and position your business for continued success. We'd love to support your journey towards a more efficient, profitable, and focused business, and watch you turn your financial challenges into opportunities for growth and innovation. And booking a discovery call is the first step towards a brighter and more resilient financial future. Now, as we wrap up this journey towards mastering your end of financial year preparation, remember this: your financial data isn't just numbers, and Xero should not be just a tool for your bookkeeper to do your BAS and your accountant to do your tax return. This is the foundation for your business's growth and stability. And we promised you a checklist, and it's jam-packed full of things that you can do to prepare for the year end. And you can expect that to hit your inbox within the next 24 hours. Some actions can be taken now, some after June 30, and some throughout the year. Depending on your business, certain things could be skipped, but others are essential no matter your industry. And if you're ready to discuss strategies to enhance your financial clarity and efficiency, we look forward to seeing you on a discovery call. For now, I'd like to take this opportunity to thank you for making this investment in your business by joining us today. Now, before we move into a quick Q&A, I'd love to know what's the first thing that you're going to do off the back of this webinar to prepare for year end. Please let us know in the chat. You told me at the beginning of the presentation what you wanted to get out of today, and I hope that you've received that, or maybe you've gotten something that you didn't know that you needed. And although I'm conscious of time, we're going to stay online for another 15 minutes or so to answer your questions. Naomi has been collating the questions and responses that have been coming through chat and some direct messages, and she's going to send them through to me now to respond to. So if you do need to jump off now, we can answer your questions in our discovery call. All right, so first question. Leon asked about paying super early to bring the expenses into this financial year. So you can definitely do it. Make sure that you check what the deadline is for your software. If you're using Xero, it's got to be lodged by the 14th because it actually needs to be in the fund by the 30th of June. So make sure that you're on top of that. Also, if you're paying additional super, just check the thresholds. You don't want to be paying more, and therefore there's going to be more tax. And yeah, that's it. Leon also asked where to find the SGC charge statements. So Leon, we can send you through a link to the ATO website. There's a document that needs to be completed. Then your BAS agent can lodge that through the ATO portal for you, help you put in a payment plan or whatever needs to be done. So Naomi, can you just flag that for me, and we'll make sure that that goes through to Leon. And it's a really good idea to keep on top of it. As crappy as it is that you need to, pay extra penalties and fines, the ATO will eventually catch up. So we don't want that. All right, so I think that's it. Oh, no. Rio asked, what if we are not making money now? How can you see? If we're not making money now, how can you pay your super? You're not making any money now. How can you pay your super? So if you've got employees, you are legally required to pay their superannuation. Unfortunately, otherwise there's an SGC charge statement applicable. Now, if cash is tight, then I'd recommend lodging the SGC charge statement, and then that way you can pay the super to the ATO, and with any liabilities to the ATO, you can put a payment plan in place. You can't put a payment plan in place with a super fund, but doing it through the ATO, you most definitely can. So that's going to get you through that cash crunch initially. And then once you've done that, be consistent and be on top of your current super so that that stays up to date. And Karen's asked for the information about the SGC charge statement. We'll send that through as well. Did anybody have any other questions that they would like to ask? Okay, so I think that's it, guys. Again, thank you for joining us today, and I wish you success in your year-end preparation, and I look forward to seeing you on a discovery call.